Hello everyone, my name is Jordan Kuzmanov and I'm the chief trader in the Traders Academy Club, which I invite you to go ahead and check out. It's one of the best places in terms of online trading clubs where you can enjoy plenty of useful information, education, discussion with other traders and so on and so on. But this is not the purpose of today's video. Today we are going to talk about the commodity channel index, or in short, as most of the traders call it, the CCI. Now, what is the CCI? Commodity channel index was developed by Donald Lambert, and it is really appreciated among the trading community. It is one of the best technical indicators, guys. Okay, it's basically used to identify reversals and overbought, oversold conditions. In other words, we can easily try to go ahead and spot extremes when we're using it. This is how the indicator looks like. It is placed, you'll see in a second in the charts that I'm going to show you. At the bottom of your chart, we're going to use MT4 here. In our examples, of course, you can find it in pretty much any trading platform out there. It is a default standard indicator, so regardless of the platform you're using, you're going to find the CCI indicator. What was the purpose of Mr. Lambert? It was to create an indicator that helped traders to spot the cycles in the commodities markets. Okay, that doesn't mean we cannot use it in other markets such as ETF stocks, indices, forex, etc. Okay, but how to properly use it, at least this is how we see it and the way we are using it in our trading, and that would be basically the purpose of this video. So a few words about how this indicator works. I did not include here the formulas. If you're interested in understanding, or not understanding, but checking out the actual formula, you can find the link to the article and you'll find the formula there. It's not a problem, but I think once it's already coded, we can go ahead and take the output of this formula and use it, right? No need to go ahead and recalculate it. All right, CCI calculates the relation between the current price to an average price over a specified period of time. Let's say you have, I don't know, 20 candles as your specific period of time, and then we have that average price. Okay, this is your average. Then we're calculating the relation between the current price, let's say the current price is here, and that average price. Okay, as an example, the indicator will read high values when price is above the average. So if this is your average and the price is above it, then the indicator is showing us higher values. Same thing, of course, happens if the price is below, then the indicator reads lower values. The average being 0, we can say that the instrument is showing bullish momentum once CCI crosses the 100 level. In CCI, it is pretty standard, and those are the default levels, of course, where we have the average is 0, okay, and then we have levels above and below it. Now, in more volatile situations, we're going to add 200. This is a plus, of course. We're going to also add 300 and so on and so on. Same goes for the minuses. Okay, but by default it was developed with the 100 levels in mind. So basically, when the indicator crosses the minus 100 level, it means the bears are taking control, and vice versa. Okay, it means there is a possibility for a downtrend to be developing. We're also going to be covering situations where the 100% might, not percent level, might mean we are not developing a new trend. Instead, we're reaching an oversold or overbought zone. And that brings up the question here, okay? Which one is it? Beginning of a new trend or an extreme? And the answer is, guys, we never know. But we do have tools that will help you understand whether a new trend is developing or we have reached an extreme and the reversal is due. All right? It's also important here to mention that whenever you're using indicators, it's very good practice to have multiple confirmations. And by saying multiple confirmations, I don't mean just add 7 more indicators on the chart and look for the same signal in the same direction. I'm talking about price action. Price action is always the number one factor on the market, on the price, and it represents the ongoing situation. It doesn't give us the output of some calculations from the past data, because this is what indicators do, right? Majority of the indicators are lagging, which means we take, I don't know, 100 bars or 10 bars or 15 bars, we do some math, and then the indicator gives you an output. That output is arrow, that output is line, that output is histogram bar, it doesn't matter. What you're seeing here as the result at the end came from the crunching the numbers from the past data. It's not related to whatever is happening at the market now, live. That's why look at the price action always and confirm it. In a second, I'll show you how exactly we're using the indicator and we're combining it with price action in order to go ahead and trade, of course. Now, how do we use CCI? As we mentioned, extreme zones is the first thing, overbought, oversold conditions, and assuming that this is the zero level, we have plus 100, plus 200. So anytime the price reaches these extreme levels, we can start looking for a reversal signs in order to catch a given trade. And the very first thing we're going to talk about is divergences. Divergences in combination with extreme conditions, or what we assume is going to be an extreme condition, works absolutely amazing. Now, for those of you who are not familiar with divergences, I would recommend you to go ahead and check out the Divergence University. You can find it at divergenceuniversity.com if you want to really go ahead and increase your knowledge in divergences. They're extremely helpful in many situations. We use them all the time on daily basis. Okay? So when we combine divergences with extreme zones in CCI, we start to get pretty decent signals. In very, very short, what is divergence? A divergence is price is creating higher highs, let's say, indicator is creating lower highs. One is going up, the other one is going down. This is what we call bearish divergence, guys. Okay, that tells us, gives us the clue that after the bearish divergence, we're supposed to see either a reversal or a pullback. And when the divergence is bearish, of course, we expect the price to push lower. Same situation goes vice versa. If the price is creating a lower lows, while the indicator is creating higher lows, we get bullish divergence. Okay? In this case, we can expect for the price to push higher. That's the very, very, very basic of divergences. But again, this video is not about divergences. It's about how we apply them with CCI to trade. So in this example, you can see the price was moving up. We're in a bullish trend. We come to a place and zone where the highs are creating higher highs, but now the indicator starts to form lower lows. And that's our first clue that a possible reversal or pullback is due. All right, so how exactly do we use the CCI according at least to our understanding, our knowledge? And this is a very simple strategy, guys. I'm sure you're going to love it. Let's start and go over the chart and the steps. I'm going to read those steps here in the box, and I'm going to show you what is meant as we go through them. First, we wait for the divergence to form. That's the part we just discussed, okay? Divergence forms. Second part is to draw the CCI trend line and wait for the breakout. How do we draw the CCI trend line? We look where the divergence happened and we look back, we look left. This is where we want to find a bottom that's not just crossing the zero level, a bottom that formed an extreme. Since this is the previous pullback and the continuation, and we created that extreme zone before that, this is going to be our initial point, the point where we start looking to draw the trend line. So we have low number 1, we have low number 2, and that's where we want to see the trend line being broken. Okay, this is point number 2. Next step is to look for retest of this broken trend line, meaning that we want to see the CCI trend line going up, holding below that trend line, okay, and look for the next thing, which is a CCI to create a new low. So basically you have pullback, you wait for the indicator line to start forming new lows, and during the first pullback you see, to form that low, we're going to start looking for the attacks. Okay? So this is how it looks. Again, trend line is broken, correction starts, this is the pullback. This is when a new low is created after this correction, right here, that zone. Once that low is crossed to the downside, so let's say at that stage it's reading, I don't know, 20. Once we have a new candle that forms and breaks below that low, so if this is 20, we need a value that is certainly below 20. Anything from 19 and down works. And once that happens, which by the way happened on this candle, okay, right here, we closed below it, we start looking for the sells. So basically, this is where the entry would be happening. This is going to be your stop loss, and you're waiting for this thing to continue lower. Okay? Let me give you another example. If, let's say, for some reason we didn't have that low here, okay, assume it was like that, then we're drawing a new trend line. The problem is, this is not really a trend line, guys. A trend line should have higher highs, at least 2 of them, okay, and at least 2 lows. In that case, if we connect the dots, we have 2 lows, but we don't have a second high. That's why that would not be a valid trend line right here. Just wanted to mention that because many people are confused when they're drawing trend lines, which is again another lesson for another time. Now, going to the next one. In this case, we have bearish trend. Okay, and here we have a good structure, right? It pushed lower, created a new high, lower high, but new high. Then it pushed down again. And this is where we have the ABCD that we just discussed, right there. So now, since the price continued to move lower and created another high, instead of drawing the trend line like this, we're going and updating it to this point. Okay? Because if we draw the trend line like that, we can see that there will be false break of that trend line, and that setup is going to be invalidated. So this is where the new high comes in play, this one, and that's our new trend line. Okay, the retest part failed. So that's the first thing. Trend line is drawn. Of course, not the first thing. The first thing is to find divergence. This is where the divergence happened. Then we draw the trend line and we're looking for this trend line to be broken, and it was. Of course, after that, we want to see the price this time creating a high. So push up, pullbacks, of course, still holding the trend line. And once that newly developed high after the breakout is broken, this is where we attack it. And that's how it looks in reality. Breakout, pullback, retest, which is holding above. And once we break that high, we want to be looking for buy possibilities. Okay, that's the candle, and you can see how beautifully the risk reward ratio would be, because that's the previous, starting from here, that's the zone. This is our resistance zone here. So that's the kind of risk reward ratio we can get. That's probably 1 to 3, 4, I don't know. Yeah, so this is our bullish example. Again, if you have any questions, leave your comments below, but I'm pretty sure you'll get the point. So that will be all for this video, guys. I really hope you enjoyed it. I invite you once again to go ahead and check out the Traders Academy Co-op. It's really a fantastic place for beginner traders, for advanced traders. It's just amazing community. Also, make sure to check out our free Telegram channel. Content is posted there almost on daily basis, trading setups, educational materials, and so on and so on. Thank you once again.